This is Arthur with eXp Realty, and I have my lending partner here, Tim Deneen, Senior VP of Keystone Funding. He has been serving my clients for several years, and we trust him with all the lending solutions. So let's get started. Today we are going to talk about all about credit, right? But let's start with credit 101. So what's a credit score, and what does it have in terms of impact in order for you to qualify for a mortgage for a client, for a buyer?
Sure. Great question. And the best summary is a credit score is a report card of your financial behaviors over, a period of time. And it's very important for you to have recent activity, right? Because the credit bureaus that issue your credit scores, they are evaluating all of the activities that you do on a daily, monthly, yearly basis. Mm-hmm. And, I could talk for forever about the nuanced pieces of it, but really on the high level, they are judging your activity for the good or the bad.
Okay, so good or the bad, right? So let's talk about the bad stuff.
For
right?
sure.
What actions can negatively impact your credit score?
So the biggest one, the most obvious one, in my opinion, is late payments, right? Mm-hmm. So, people are either they're really vigorously monitoring their credit and their activities, or they're not, or they're somewhere in between, right?
Right.
And so for example, if you have phenomenal credit and you miss a payment, you have a late payment, it could be very detrimental. You could lose upwards of like 100 points. And I've seen that.
Wow, that's crazy.
Yeah. So the higher your score is, the bigger the impact, but late payments being one, and one that you can control. Another one being collections, right? So if you just stop making payments, right, regardless of what caused you to stop making payments, and you don't have some sort of legal or structural agreement in place with the creditor, they can send you to collections, and that's kind of where a lot of people's credit journey stops. And I wish it didn't, right? Because you have the ability to fix it at that point.
Right.
It's about having the faith in yourself to make the right activities, and then do some of the small things to improve your credit.
Right. Let's move forward with the ways to improve your credit score. So what are some of the ways to improve your credit score?
Sure. So when people are evaluating credit, right, especially someone who's had some sort of negative credit in the past, or someone who's young and doesn't understand credit, they think that you have to have this big, complex credit profile to win. But really, it's about small, repeatable activities, mm-hmm. right? So step one is open a credit card. That is my advice. And if your credit is either too damaged or too new to be able to open a credit card, then there are what are called secure credit cards. And I'd be happy to talk more in depth about that or help mm-hmm. someone. But really, it's about opening a credit card, using it very sparingly, using it every single month, using technology, right? There really are no excuses now. Using technology to make sure that you're auto paying your minimum payments, mm-hmm. and just make it on autopilot, right? So when I'm talking to my clients, you open a credit card, you get a bag of groceries, you wait till the bill is due, you pay it off. The next month you do the exact same thing. Sure. And just make it methodical.
So make it methodical and make it consistent, right? Consistently paying off the debt that you accumulated over the month, which will improve your credit score over time. So let's talk about low credit, right? What if someone has low credit? How long does it take for that person to improve the credit? So let's talk about, let's say one person has credits around 500s. Yeah. How long does it take for that person to go up to maybe 700 credit scores?
So I'm going to break that down into two pieces. So first of all, just like I said, when you have high credit, it's really easy for it to drop. When you have low credit, it's easier for it to go up.
Yeah.
So I would say from 5 to 600, right? There's usually more like long-standing problems. Probably if you're in the low 500s, you probably don't have much credit activity. You probably have some negative items. And I see far too many people again, that stop at the negative and they don't get the positive in place, because every day that passes, the negative gets older and less impactful to your credit. And then the positive, if it's there, gets more impactful. But most people don't do the positive. So if you are speaking directly to anyone who's suffering right now with credit, figure out a way, talk to someone like myself or Artur, but figure out a way to get some positive credit in your life to start making those steps. Because usually when they come to me, it's too late, right? And they want to buy right now. And unfortunately, that's not the way credit works. But I would say with the right plan in place and the determination and the dedication, somewhere in the ballpark of 6 months to get from the 500 credit score to the low 600s. And then you're talking being able to qualify for a lot more programs. But really getting above 680 or 700 takes a little bit more work, because that is about the month over month positive activities. I will tell you, in the last 10 years, I've had a handful of people who came to me. I've had plenty of people who came to me desperate and needing, help. And then I've had a handful of them that actually worked with me and listened for, months and years. But some of them went from the 500s to the 800s because they totally changed their ways and they believed in themselves. It's a very long answer.
No, that's totally fine. Yeah. It's not an overnight process. It takes time and effort to be able to go up, to improve credit score. So,
sure.
You said people came to you and last minute, right? And they would like to buy a house tomorrow, but it takes time. So let's talk about the pre-approval process a little bit. What factors are evaluated during the pre-approval process to determine whether a buyer is qualified for a loan?
Sure. So we've talked about credit, right? So it's really about credit score, and there are minimum thresholds for different programs. Credit score, debt to income, right? What is your salary or what is your income? And depending on how, depending on the complexity of your income, that might be a very straightforward answer, like a salary, or it might be more complex, and we'd have to look at more documents.
What's the debt to income ratio, sort to cut you off?
Sure.
But, like a typical debt to income ratio, I know each loan program might have a different answer to that, but all across the board, what do you see? Yeah,
a good rule of thumb is 45% of your gross monthly income would be including all minimum required payments on your credit report plus the new mortgage.
Okay.
So if we take very easy math, if you have a $10,000 salary or $120,000 a year in income, that would allow you $4,500 in debts.
Okay.
Yeah.
That's perfect. As far as the pre-approval process, right? How long does it take to get a pre-approval letter from you?
Yeah. So two things. How complex or how simple is your situation, and how committed are you to doing what I need you to do?
That's the most important part, right?
100%.
Yeah.
If it's simple and you're willing to do the work, same day, all day long. If it's complex, then we're going to need more documents. We might need to contact your employer. We might need some letter of explanations, whatever it is. I've seen it all. Right. Been doing this about 10 years now. If it's simple, I love helping all people, but the simple ones, I'm able to help people quickly. And if they seek me out and they want my help, I would love to do it same day, get them into a home.
Absolutely. And, I've experienced the same day pre-approval letters and making offers the same day, right after we show properties, and then we reach out to you and everything is ready to go with their documents, and they fill out the loan application and you give them the pre-approval letter the same day. So as long as everything is in order, I think, it's a very simple and easy and fast process. So what are some of the things that would disqualify a buyer from getting a loan?
They are similar to what damages people's credit, right? If you have recent late payments, then that's going to both negatively impact your credit score, and it's potentially going to impact the qualification, right? One of the first steps that we use after we pull credit, after we get documents, is to run through an automated underwriting system. And that's using all that data and all the technology, and late payments is very detrimental.
Right.
Unresolved federal debt, student loans, those can be issues. Gaps in employment or surprises in the application, right? If we pre-approve someone and things aren't what we believed, or they lose their job, or we pre-approve someone with the expectation that we need additional documents, and those documents are different. Another one that we run across from time to time is people's residency status, right? So you have to meet the requirements of the loan program and have the authorization to work here legally in the U.S.
So a green card holder, a U.S. citizen, obviously.
Correct.
And how long does it take for them to qualify for a mortgage if they have a simple credit card issue, like a debt, like a late payment? How long does it take for them to qualify again? Like a ballpark.
I would say worst case scenario is going to be 12 months.
Okay.
If when we're talking about mortgage lates, that can be more complex depending on did it hit foreclosure,
right,
things like that. But if we're talking about consumer debt, I would say somewhere between 6 to 12 months, depending on when the last activity was, when that occurred.
It can be a very simple credit card debt that you forgot.
If you buy new furniture, use cash or existing credit. Definitely don't want to open any new lines of credit, even if it's free interest or 0% interest. Wait till after closing. Don't switch jobs without consulting your loan officer. Don't quit your job. Don't get fired. And this is a big one, and this is really common. Don't move money around, right? Because then you're going to be looking at the loan officer like, why are they asking me for all this documentation? And the loan officer's looking at you saying, why are you making me ask you for all this documentation?
Right.
Get your ducks in a row. Talk to the loan officer, ask questions, but don't move any money around just for the sake of moving it around. It's really unnecessary. Once they get through the approval process and they clean up all the conditions, move it around all you want, but make it easy on yourself.
Perfect.
Yeah.
What about the fees that they are responsible to pay at closing?
Sure. In our industry, we commonly use 2.5% to 3% as a closing cost estimate. And that's not just lender fees, right? So that's comprised of lender fees, fees to an HOA if you have an HOA, fees to the government, taxes. That can be really substantial depending on the jurisdiction, the state. Title fees, homeowners insurance, and so they, depending on again the state and the purchase price, I think 3% is a good ballpark.
Right. So a typical $500,000 home, you need to budget for $15,000 just for the closing costs. And on top of that, you are responsible for the down payments. So these are all my questions. Appreciate your time, Tim. And
absolutely.
Definitely reach out to Tim if you have any questions about loans or if you have any questions about credits. We are here to help. Take care. That's it, buddy.
My first podcast.